Welcome back, everyone. Today, John and I wanted to talk to you about the new tax legislation that passed a few weeks ago, the Big Beautiful Bill, referred to as OBBBA, and how these changes, or some of the things that didn't change, could affect you on your 2025 taxes and over the coming years. So, first and foremost, the marginal tax rates did not change. We kept our same 7 rates in those same brackets, those being the 10, 12, 22, 24, 32, 35, and 37% brackets.
Which the good news there is they were scheduled to sunset this year, so
That's right.
they've been made permanent. They're going to stay for the foreseeable future, which is great because they are pretty historically low income tax rates.
That's right. So, John, what else? What else changed? What else stayed the same?
Well, the standard deduction again that got increased under the first Trump presidency, where it essentially more than doubled, I believe. That is staying permanent as well. They actually increased it a little bit. It was going to be 15,000 for an individual, 30,000 for a married couple. It's 15,750 for an individual and 31,500 for a married couple. In addition to that, if you're 65 or older or blind, you get that additional standard deduction.
Hmm.
It was $1,600 per person if you're married and $2,000 if you're a single filer. And also, the estate exemption has been made permanent or didn't sunset and revert. And that's now $15 million per person. So between a married couple, they can pass on $30 million without estate tax.
And if one spouse dies, the other might be able to get their 15 million to still have a 30 million
Still portable.
portable
Hmm.
on the estate tax exemption. Now, there were several new additions and several parts of the tax code that changed. One being the new senior deduction for those 65 and older. This was really passed in lieu of the no tax on Social Security proposal that was made. It's a temporary $6,000 deductions for individuals 65 and older, 12,000 for married couples filing jointly if both are 65 and older. So with the trickle down effect there, less Social Security income will likely be taxable because of this deduction. However, it's only available starting this year, 2025 taxes through 2028, and this starts to phase out at higher incomes. So if your adjusted gross income is above 75,000 as single or 150,000 married, you start to lose some of that $6,000 senior deduction until it's completely phased out.
This is kind of similar to the old personal exemption
Yes,
because this isn't like the standard deduction section if you're not itemizing on Schedule A. It's just an extra line that will have this deduction.
and they made permanent personal exemptions are gone, but then they added this one on it, but just for 65 and older.
Speaking of Schedule A, there were some changes to charitable deductions. One thing that is good, if you don't itemize on your tax return, there is now an amount that you can take as a charitable deduction for cash gifts. It's $1,000 for an individual or $2,000 for married filing joint. We kind of saw that during
We
COVID.
saw it during COVID. I think 2 years
Hmm.
standard deduction filers got an additional charitable tack on.
So, yeah, everybody needs to keep in mind what their charitable gifts are, even if you're taking the standard deduction now. You don't want to miss that. However, something that's kind of new is going to be a hurdle, or it's a percentage of your AGI, 0.5% of your AGI. If you're itemizing on your deductions, you will lose 0.5% of your AGI against your charitable deductions. That's kind of similar to the medical expense floor, which
Right,
is 7.5% of your AGI.
right.
So that one really didn't get talked about. That was kind of a
Yeah,
surprise when I saw it.
yeah.
Also, the state and local tax, that one was capped at $10,000 with the first Trump administration tax legislation, and it has been increased to $40,000 now. However, there's a phase out. If your income is over $500,000, that starts getting phased out. So,
may not see the full benefit for the highest income earners. And this includes, so for Tennesseans, we're usually talking about property tax and sales tax since we don't have income tax. But for high state income tax states, this was something they were really hoping for because of that $10,000 cap. Now it's increased to 40 if you're under a certain income threshold. There has been an increase in the child tax credit from 2,000 to 2,200, and there's also a phase out on that. You're going to hear a lot about phase outs. So we should preface this with talk to your CPA, discuss with us, because not all of these are going to apply to you, even if it's a new rule and it seems like it. It's all income dependent on a lot of these.
well, it's even hard for us to explain all the different phase outs in a video because all these different phase outs kind of have some nuances that go along with it. So
Right.
we're just telling you the income range and just know there's a phase out.
Yeah.
But yeah, there's some details beyond that.
Rather do a true tax projection on it. On the child tax credit, the phase out starts at 200,000 for single filers, 400 for married filing joint, and up to 1,700 of that 2,200 can be refundable. So not a deduction, but a true refund to you.
Tips and overtime, that was a hot topic during the elections and a lot that President Trump touted. And the details behind it is from 2025 to 2028, you can deduct up to $25,000 of your tips to make them non-taxable. Again, phase out. That phase out is 150,000 for individuals, 300,000 for married filing joint. Overtime pay, it's a little bit less, $12,500, 12,500. Same year as 2025 to 2028. And the phase out range is the same, 150 for single, 300 for married filing joint.
And the last we wanted to cover today, we tried to pick the ones we thought might apply to the most number of clients. There is a new auto loan interest deduction. So for buying new cars in 2025 to 2028, technically the vehicles have to be assembled in the U.S. You can deduct up to $10,000 per year of interest on auto loans tied to those new car purchases.
That's an expensive car, if you think about it.
If you're getting the 10,000,
I mean, if you buy a $50,000 car and the finance rate is 6%, I mean, that's $3,000. So
yeah.
what are people driving?
Well, and there's also an income phase out.
Yep.
So
Those that can
presumably
afford the fancy cars may
won't
not
get the deduction. So if you're getting all 10,000 of that deduction, let's talk about it.
Yeah, these are just some of the highlights. It's still pretty new into this bill being released, so we're still kind of absorbing it and digesting it. Again, these the phase outs, if nothing else, are kind of complicated to know, what percentage above a certain amount gets phased out. We'd be happy to help you understand how this affects your tax bill. We've got some great tax planning software where we can take your tax return and apply it to this new law compared to what the law was going to, so you can see, how it impacts you personally. But we hope you found this helpful, and let us know if you have any questions.